The four most expensive words in investing don't appear in any financial statement. This time, it's different. The truth no one wants to hear? That's exactly the signal of a bubble that's quietly inflating. The four big lessons from stock market history. In the investing world, there is a truth everyone knows but very few people truly accept. History always repeats itself. Even though the market has gone through countless boom-bust cycles, investors still tend to reassure themselves with reasons that sound convincing that this time it's different. But those are exactly the four most expensive words in English, according to legendary investor Sir John Templeton, who achieved an average return of 15% per year for 38 consecutive years. He said that because nothing drains an account faster than blind optimism disguised as financial genius. This idea was also echoed by Jesse Livermore, one of the greatest speculators of all time.
He believed that on Wall Street, there is nothing truly new because human nature and greed never change. Everything happening today has already happened before, just in a different context and with a different way for investors to fool themselves. And then, every time the market heats up, the mindset of "this time is definitely different" reappears. It makes investors believe they're holding a golden opportunity, that risk is almost zero. But in reality, every single time that happens, history proves the opposite. It's just another loop in the same old cycle. 2. Jesse Livermore and a classic perspective. When we talk about Wall Street legends, the name Jesse Livermore is almost impossible to leave out. He is considered one of the founding figures of modern speculation and is also the inspiration for the main character in the classic book Reminiscences of a Stock Operator, a work that almost everyone stepping into the market has at least heard of. Livermore was famous for his ability to read crowd psychology, and especially for earning massive profits during crises by shorting the market. But what keeps his name alive isn't just his famous trades. It's a line that became a kind of compass for generations of investors. There is nothing new on Wall Street. Speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. That quote reveals a harsh but extremely important truth. Every bubble in the market, no matter how much it is wrapped in a new layer of technology, a new trend, or a new story, always originates from very old emotions, greed, illusion, and overconfidence. And exactly because they failed to learn that lesson, investors in the early 1970s fell into one of the most dangerous bubbles that few people mention today, the Nifty 50 bubble. In their eyes, top blue-chip stocks were seen as immortal, to the point where people believed that as long as you bought and held forever, you simply could not lose. That cannot be wrong mindset laid the groundwork for a collapse that forced the entire market to pay the price for many years. 3. The Nifty 50 bubble, the bubble no one talks about. The story of the Nifty 50 bubble begins in the late 1960s when the United States was at the height of its prosperity after World War II. The economy had been booming for more than 20 years. Factories were running at full capacity. Suburban neighborhoods were popping up everywhere, and Americans were immersed in the feeling that their nation was almost invincible. They had just won the war, sent people to the moon, and possessed a series of iconic inventions of that golden era. Confidence and optimism were everywhere. In that context, the stock market became a symbol of American strength. From 1945 to 1970, the market rose more than 350%, a gain that made investors believe a new era had truly begun. This optimism led to the birth of a wildly popular investment trend at the time, one-decision stocks. The idea was very simple. You only needed to make one single decision, buy, and then hold forever. No selling, no worrying, no further analysis. Because the companies selected were all corporate giants, familiar in everyday life, and believed to endure through time. From Coca-Cola, American Express, McDonald's to Xerox and Polaroid, all of them formed a legendary group of stocks called the Nifty 50. Investors saw them as can't-fail assets, to the point where any thought of selling was considered crazy. Yet it was precisely this feeling of absolute safety that turned Nifty 50 into a giant bubble, and no one realized the fuse had already burned all the way down to the detonator. 4. The irrational valuation of Nifty 50. When faith in Nifty 50 reached its peak, the only thing rising faster than investor optimism was the valuation of these stocks. By the early 1970s, prices in the Nifty 50 group were not just high, they were high to the point of denying basic principles of business valuation. While the overall U.S. market was trading at a PE of around 15, a level seen as reasonable and healthy, Nifty 50 had surged to what could only be called financially unreal. Companies once viewed as stable and mundane had suddenly become stocks priced as if growth was limitless. Coca-Cola traded at a PE of 46, Xerox at 49, McDonald's reached 86, Polaroid even hit a PE of 90, a number you would only expect to find in textbooks or financial fairy tales. On average, Nifty 50 stocks were valued at 42 times earnings, nearly 3 times the broader market. But the danger wasn't just that they were expensive. It was that they accounted for a massive share of the entire market. The 5 largest names in the group made up nearly 25% of the total U.S. market cap, and the entire Nifty 50 group accounted for up to 45%. This meant that every dollar flowing into index funds at the time was essentially a bet heavily concentrated on this overheated group. Investors treated Nifty 50 as immortal assets, buying unconditionally. And because everyone believed they couldn't be wrong, more and more money poured in, pushing prices even higher and creating a self-reinforcing feedback loop. But beneath the shiny surface of that confidence, a bubble had swelled so large that just a light tap was enough to make the whole market shudder. 5. The 1973-1974 collapse. By 1973-1974, the pieces of a financial disaster were finally falling into place. All the market needed to wake up from the Nifty 50 intoxication was a strong enough series of macro shocks, and they arrived almost simultaneously. Oil prices suddenly quadrupled, driving production and transportation costs sharply higher around the globe. Inflation jumped from 3% to over 11%, eroding incomes and consumer confidence. Unemployment doubled from 4.5% to 9%, pushing the economy into exhaustion. As if that weren't enough, President Nixon put a final end to the gold standard, causing the monetary system to experience a huge shock. All of this combined into a perfect economic storm, and the U.S. stock market plunged 50%, marking the steepest decline since the Great Depression. In that panic, the supposedly immortal Nifty 50 stocks didn't just correct, they were crushed. Coca-Cola lost more than 60% of its value. McDonald's dropped over 70%. Polaroid, once the symbol of limitless growth, crashed more than 90%, nearly wiped from the board. The stocks that had once been seen as only buy, never sell, turned into painful proof of collective delusion. Worst of all, the wound didn't heal quickly. There was no V-shaped recovery, no miracle. It took 8 years for the market to return to its previous level. For many investors, it wasn't just a drawdown. It was nearly a decade of being stuck in losses and despair. 6. Today's backdrop? Déjà vu. Looking at today's market, many investors are beginning to feel a strangely familiar sensation, déjà vu. History may not repeat itself exactly, but as Mark Twain famously said, it often rhymes. And when you place today's picture next to that of 1972, the similarities are hard to ignore. In the Nifty 50 era, the 50 largest stocks accounted for up to 45% of the total U.S. market value. Every dollar flowing into the market was, in effect, an indirect bet on a group of stocks that were wildly overvalued but considered absolutely safe. Today, history seems to be retelling the same story with a new cast, the Magnificent Seven: Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia. Even though there are only 7 names, the group holds about 36% of the S&P 500's weight, a concentration that's hard to ignore. Once again, the market is placing nearly all of its expectations on a handful of companies considered untouchable. Everyone believes they will keep growing forever, that they can't collapse, that they can't be wrong, just like the faith once placed in Xerox, Polaroid, or Avon decades ago. But the problem isn't just concentration. The valuations of the Magnificent Seven are also soaring in a way reminiscent of Nifty 50. Meta and Google trade at nearly 30 times earnings. Apple and Microsoft exceed 35 to 38 times. Nvidia sits around 50 times, and Tesla has reached a more than extreme 200+ multiple. Each number is sending the same message. Investors are paying for the future as if risk has disappeared. Once again, the market is whispering the 4 familiar words. This time, it's different. But history has always shown that the moment people believe nothing can go wrong is exactly when the danger is greatest. 7. The current valuation of the Magnificent Seven. If we look at the current valuation of the Magnificent Seven, we see a picture not so different from what happened with Nifty 50 more than half a century ago. These are all fantastic businesses, technological leaders with clear competitive advantages, but their stock prices are reflecting expectations that are almost detached from reality. Google and Meta are trading around a PE of 28, already higher than the market average. Amazon is at 35 times earnings, Apple at 37, Microsoft at 38. Nvidia, the brightest star of the AI era, is valued at 50 times earnings. And Tesla has completely broken away from conventional logic at around 247 times earnings. These numbers show that investors are willing to pay as if these companies can grow forever and are immune to any kind of risk. The real issue is that market psychology is repeating the story of 1972. Investors believe there is only one decision: buy and hold forever. No worries, no revisiting valuations, no consideration of risk. The Magnificent Seven are becoming the modern version of one-decision stocks. But history always finds a way to remind those who forget it. Just a few macroeconomic shocks, higher interest rates, slowing growth, disappointing earnings, can quickly turn these reality-defying valuations into a burden. Warren Buffett once said, "The only thing we learn from history is that we do not learn from history." And once again, we hear those 4 familiar words echoing. This time, it's different. But the market has never been kind to excessive confidence. Investors are repeating old mistakes. Looking at everything happening in the market today, it's hard not to feel a sense of repetition. Modern investors, equipped with advanced technology, abundant data, and trading speeds far beyond the past, are still falling into the exact same behavioral patterns as previous generations. Once again, they reassure themselves that the market's largest companies will always grow, that risk has been designed out of the system, that high prices simply reflect a bright future. That exact illusion turned Nifty 50 into a massive bubble back in 1972. And today, 50 years later, the story is being retold with a new cast. The Magnificent Seven, symbols of technology, innovation, and growth, are being treated as if they are immune to all market laws. Investors believe there's only one decision: buy and keep buying, because this time it's different. But the reality is, the market has never operated according to what people believe. Valuation always matters. Risk always exists. And every bubble in history shares one thing in common: it swells the most at the very moment everyone believes nothing can go wrong. Warren Buffett once said, "What we learn from history is that people don't learn from history." That quote serves as a reminder that overconfidence always comes with a very high price. Today, while many people are quietly repeating the 4 familiar words, "This time it's different," perhaps the wisest thing we can do is look back at the past and recognize that those words have never once turned out to be true. 9. Conclusion.
When we piece all of history together, we see a picture that's frighteningly familiar. The market always repeats itself, only changing faces and time periods. The Nifty 50 bubble was once considered too big to fall, but it shattered after just a few macro shocks. And now, under the dominance of the Magnificent Seven, many investors are nurturing the same belief that market-leading companies will always grow, always be stable, and always be immune to shocks. Yet history has never supported that kind of thinking. The biggest bubbles tend to form in the most optimistic environments. Investors back then did not lack information, nor did they lack warnings. They just lacked humility. They believed that today's market was stronger than in the past, that the financial system was more robust, that technology was more advanced, and therefore everything would surely be different. That is the biggest trap. The reality is much simpler. Overvaluation always carries seeds of risk, whether it's 1972 or 2024. When expectations stretch too far beyond what businesses can actually deliver, just one small stumble is enough to send the market reversing in a way nobody can react to in time. Those 4 words, "this time it's different," may sound hopeful, but history shows they almost always become the opening line of a very expensive lesson. And perhaps the most important thing every investor needs to remember is this: the market doesn't care what we think. It only reflects reality, and reality never changes for anyone. 10. A suggestion for you. Even though stock market history shows many cycles of bubbles and crashes, that same history also proves one positive thing. The market always recovers and continues to grow stronger over time. Major upheavals help the financial system become more transparent, businesses operate more efficiently, and investors become more mature. The rise of the Magnificent Seven also reflects the power of technological innovation, the ability to create real value, and the long-term vision of the world's leading companies. If investors can stay rational about valuation, balance risk, and remain patient with long-term goals, they can still capture great opportunities during market corrections. Every turbulent cycle is, in reality, the foundation for the next phase of growth.